Hello students, hope you are doing well. Today we are going to start a new chapter, that is provision and reserve. This chapter is very important for the point of view of theoretical part and for the examination. This is 17th chapter, and in this chapter we are going to discuss about the meaning of provision and reserves, difference between them, and the different types of reserves. So let's start. So first of all, what is the meaning of provision? The term provision means any amount written off or retained by the way of providing depreciation or retained by the way of providing for any known liability. It means the amount written off or retained by the way of providing depreciation or any known liability, and it should be clearly understood that if the amount of known liability can be determined with a reasonable accuracy, it must be classified as a liability, and for that not provision is made. It is maintained for uncertain accurate amount for meeting or knowingly the contingency of the business. There are several examples about the provision, like you make provision for depreciation or doubtful debts, for taxation, discount on debtors, and repair and renewals. Provision is made to meet a known liability, and the amount of such liability cannot be determined. It can be only make approximate amount. Okay, so it helpful in knowing the true profit of the business, financial position, future losses, and distribution of expenses. Accounting treatment for provision. Now here is example given of depreciation and doubtful debts. So we will discuss about the doubtful debts. There are three types of debtors. Some are good debts, which are pay money at certainty, as we can say that those debtors from whom the collection of money is certain. Bad debtors, those debtors from where the collection of money is not possible. And doubtful debts are those who may pay but business firm is not sure about the collection of full amount from them. So for this we will make provisions. Journal entry for creating provision for doubtful debts are profit and loss account debit to the provision for doubtful debts account. As you know, this is the nominal account, and the rule of nominal account is what losses are to be faced by the company should be debited and gains are credited. So here it is a loss, so it will be debited. Reserves. Any sum which is appropriated out of profit are the most important part of reserve. Any sum which is appropriated out of profit and loss appropriation account, and it is not meant for covering up the liability, any contingency or commitments or reduction in the value of an asset, is a reserve. Reserve mean amount set aside out of profit and the other surpluses to meet the future uncertainty. In other words, reserve is meant for meeting any unknown liability. So here a basic difference between provision and reserve are provision are made for known liability and reserves are maintained for unknown liability. Okay? Now Reserves are appropriation of profit to strengthening the financial position of the business. Reserve is not a charge against profit, it is appropriation of profit. It means if in any year company does not get enough profit, so they don't make any reserve. It is only maintained if the company is earning profit in the current year. Okay? Now, the example of reserve are general reserve, workman compensation fund, investment fluctuation fund, capital reserve, dividend equalization reserve, reserve for the redemption of debenture. So it is very important for the business as it helps in meeting unforeseen liability, strengthening the financial position, equalization of dividend, and providing funds for meet specific liability. Sometimes the reserves are made for specific purposes, so it is very important. Now, what are the basic difference between reserves and surplus, reserves and provision? So first is basic nature. Provision is charge against profit. It means the creation of provision is legal necessity. Provision have to be provided for even if there is no profit. But in reserve, it is appropriation of profit and it can only be maintained if the company is earning adequate profit and have been earned. Okay? Now the purpose is provision is created for the known liabilities or expenses, but reserves are made for strengthening the financial position of the business. Next is effect on taxable profit. So it reduces the taxable profit, and reserves, there is no effect on taxable profit. Now, what are the presentation in the balance sheet? So provision is deducted from the assets and also see along in the liability side. But in reserve, it's shown on the liability side after the capital. Now, the element of compulsion. So provision is compulsory to be maintained, but reserves are not created unless there are profit. And last is use for payment of dividend. Provision cannot be used for the dividend distribution, but reserve can. So this is the basic difference between reserves and provisions. What are the types of reserves? First is general reserve, second is specific reserve, revenue reserve, and capital reserve. So the general reserve are when the purpose for which the reserve is created is not specified, it is called general reserve. It is also termed as a free reserve. So usually the businessmen do not withdraw any profit or entire profit from the business, but retain part of it and the business to maintain the reserve for future liabilities. Profit so retained in the business for any purpose known as general reserve. It helpful in strengthening the financial position as well as for equalization of dividend. Now specific reserve. Specific reserves are those reserves which are maintained for some specific purposes. There are some examples like dividend equalization reserve, workman compensation fund, investment fluctuation fund, and debenture redemption reserve. Now, revenue reserve. Revenue reserves are those reserves comes into existence out of profit which have been earned in the course of day to day. So, it is arise out of the normal operating activity of the business. Okay? So, this reserve is very important and it is a head of general reserve, workman compensation fund, investment fluctuation fund, and dividend equalization reserve. Now, what are the capital reserve? These are created out of capital and which do not arise from the normal operating activity. Such reserves are not available for distribution as dividend. For example, the premium on issue of share or debenture, profit on the sales of fixed assets, and profit on the redemption of debenture. Okay, so debentures, what are debentures? Debenture is a credit instrument which are given by the reputed company with a collateral security. Collateral security here means secondary security. Okay, so such reserve is created for the finance purpose, like for replacement of assets at the end of what life? Useful life. Okay, the amount of annual depreciation charge on assets is only capable for providing the original cost of asset, but the replacement of asset will be required large amount of money. So due to the inflationary trend of price, we have to make some funds for the exchanging or changing that fixed asset. So capital is generated from the capital profit, like from the sales of any fixed assets, and they are not available for distribution of dividend. Like you can arise capital reserve through sales of fixed assets and liability revaluation, issue of share or debenture, purchase of running business, etc. Now, what are the difference between capital reserve and revenue reserve? So, source of creation of revenue reserve is created out of profit, but it is maintained from capital profit. Purpose of revenue reserve is strengthening the financial position. Capital reserve is created for the compliance of the legal requirements or accounting practices. And the usage of revenue reserve is a specific revenue reserve can be utilized only for the earmark purpose, but general reserve can be utilized for any purposes. But capital reserve is utilized for the specific purpose as provided in the law. What are the importance of reserve? It is very important because it will help you for meeting future contingency, strengthening the general financial position of the business, redeeming the long-term liability like debenture, etc. Now, what is secret reserve? A secret reserve is one which do not disclose by the balance sheet. Okay, sometimes the company do not tell about this reserve. So secret reserve is reserve which do not appear in the balance sheet. It may also help to reduce the disclosed profit and also the taxable liability. Okay, tax liability. So secret reserve can be created in the following way. Undervalued of inventories, undervaluation sometime done for any inventory, so you can maintain secret reserve. Charging capital expenditure to profit and loss account, making excessive provision for doubtful debts, and showing contingent liability as an actual liability. Now, this is the end of the video. You can remember many examples about the secret reserve, for revenue reserve, for capital reserves. These are very important. So now I hope you understand the difference between revenue reserve, capital reserve and the provision, and try to remember all of them because these are very important for the exam point of view. Okay, if there is any doubt, you can ask me. Okay, thank you.